You ever wonder what really keeps a bank manager up at night? I'll give you a hint. It's not just about approving loans or counting cash. No, it's about this hidden, incredibly powerful force that can rock their entire institution seemingly out of nowhere. We're talking about interest rate risk. So let's get right into it. Think about a bank as this really complex financial machine, right? But the main dial that controls its core settings, the interest rate, well, that dial is constantly being turned by forces in the global economy. So what actually happens inside that machine when that crucial dial moves, especially when it moves unexpectedly? To get a handle on the risk, we first have to understand the machine itself. And at its heart, a bank's job seems almost simple. It's basically a big balancing act. It takes in money from people who want to save, and it lends that money out to people who want to borrow. And this is the core of how it all works. On one side, you've got liabilities. That's your deposits, the money the bank owes its customers. On the other side, you have the assets. That's all the loans and securities the bank is investing in. And the whole thing is built on a foundation of bank capital, which is really the bank's own skin in the game. A bank makes its money on what's called the spread. It's a simple idea. Just charge a higher interest rate on its assets, like loans, than it pays out on its liabilities, like your savings account. Sounds straightforward, but this whole business model is super sensitive to that one thing that's always changing, interest rates.
So yeah, keeping that balance isn't nearly as simple as just watching that profit formula. A good bank manager is basically a professional juggler, constantly managing four big worries to keep the bank safe and, of course, profitable. First up, there's liquidity management, making sure there's enough cash on hand. Second, asset management, making smart loans that won't go bad. Third is liability management, finding cheap and stable sources of money. And finally, capital adequacy, keeping a big enough cushion to absorb any surprise losses. Each one is a moving part, and the invisible force that can throw a wrench in all of them is interest rate risk. And this really brings us to the central puzzle. Because if you want to manage interest rate risk, you've got to understand what an interest rate truly is. And trust me, it's not just the number you see on a billboard. We have to talk about the real interest rate. This is the number you get after you account for inflation. It tells you the true cost of borrowing money and the true return you're getting for lending it out. At the end of the day, this is the number that really matters. And this is why a surprise in inflation is such a huge deal. If inflation ends up being higher than everyone expected, borrowers get a great deal. They get to repay their loans with money that's worth less. That means the lenders, and remember, banks are massive lenders, they lose. But if inflation is lower than expected, the tables are turned. For a bank, getting this prediction wrong is a massive financial risk. So, how on earth do banks manage all this uncertainty? Well, let's look at the first tool in their kit. It's called gap analysis. A good way to think about it is like a short-term weather forecast designed to see how the bank's income will hold up in the near future. What gap analysis does is it measures how sensitive a bank's profits are to changes in interest rates. It zeroes in on the assets and liabilities that are rate sensitive, which just means their interest rates are going to change sometime in the next year. Okay, let's walk through a quick example from our source material. Imagine a bank has more liabilities that are about to get repriced than assets. In simple terms, its funding costs are more flexible than its income. Now, what happens if interest rates suddenly fall by 5%? Boom! The bank's profit for the year shoots up by $900,000. Pretty great, right? It's because the interest it has to pay out on its liabilities drops more than the interest it's earning on its assets. But here's the scary part. If rates had gone up by 5% instead of down, that huge profit would have flipped into a devastating loss. That's the risk. So that short-term forecast is super useful, but a bank also needs to check the fundamental structural integrity of the entire building, so to speak. And for that, they pull out a much more powerful tool, duration analysis. This is a much bigger picture approach. See, where gap analysis worries about next year's profits, duration analysis asks a bigger question. What happens to the bank's entire net worth right now? It calculates how the market value of everything the bank owns and everything it owes changes when interest rates move. All right, let's run another scenario. We've got a bank with $100 million in assets and $95 million in liabilities. So what happens if interest rates just nudge up by a single percentage point, from 10% to 11%? The bank's total net worth takes a hit of $1.6 million. Now, this isn't just a dent in 1 year's income. This is a direct blow to the fundamental value of the entire bank.
It just goes to show how a seemingly tiny rate hike can cause some serious structural damage. Okay, we've looked at the technical stuff, the tools of the trade. But why should any of this actually matter to you? Well, because the risks being managed on those bank balance sheets have a direct line to the health of the entire economy, and yeah, ultimately, to your wallet.
And the reality here is pretty stark. As our source material states, a manager who gets this call wrong, who misjudges these interest rate movements, could literally bankrupt the bank. The stakes aren't just about making a little less profit. We're talking about survival.
And here's the thing. A bank failure is never just an isolated event. It creates this dangerous ripple effect. It can destabilize the wider economy. It can choke off the supply of loans that businesses need to grow and that people need to buy homes. And maybe worst of all, it can shatter public trust in the entire financial system. What happens inside that one bank really does matter to all of us.
So at the end of the day, this is the banker's dilemma. They have all these sophisticated tools to measure risk, but they're still making a judgment call about a future that is fundamentally uncertain. And it leaves all of us with a really critical question for our entire financial system. In a world of constant, nonstop change, how much risk is too much?